Do you really know what returns your portfolio is actually giving you? We all have our own style of investing, like blue chip stocks or even random stock tips from Telegram groups. But regardless of how we invest, most of us feel satisfied just by looking at the absolute percentage returns. Here is a common myth. As long as my returns are positive, my portfolio must be doing fine. The fact is, those absolute returns might make you feel confident, but they don't tell you the full story. For example, are you genuinely growing your wealth over time? And more importantly, are you even beating the market index? In this video, I'm sharing what I've learned from 7 years of investing as a DIY investor. How to calculate your actual investment returns and compare them with NIFTY the right way. Let's get started. We invest in mutual funds, stocks to grow our wealth. But here is the challenge. If you are not tracking your returns properly, how will you measure whether your wealth is actually growing? Think of it like going to the gym. You are putting efforts, lifting weights, but without stepping on the scale or checking your progress. How would you confirm it's working? Tracking your portfolio returns the right way is like getting a fitness report for your investments. So how do you evaluate if your returns are decent and what should you compare them against? This is where most of us get it wrong. We look at our absolute returns and think, great, I'm up 12%, so I must be doing fine. But compared to what? That's the key question. Here is where two numbers come in, your portfolio returns and the market index returns. Your portfolio returns, often measured as XIRR, are like your personal scorecard. They factor in every deposit, withdrawal, or the trade you have made, basically the real story of your investments. Now the index returns, like those of NIFTY or SENSEX, are the market's average performance. Think of them as the class average. They answer the big question. If you had replicate all the cash flows in a simple index fund, that's the return we deserve to get. Alright, now you know what to compare. But how do you calculate these returns? Simple steps. Okay, so let's say this is your collated trade book. So firstly, I'm hiding all the unnecessary columns here. Hide columns. Then I'm creating a cash flows for calculation of XIRR. So here I'm using price into the quantity and I'm using if statement. And I'm dragging this all the way down to all rows. So this is how we'll get our cash flows. So why we need in this specific format is if we are investing some amount. For example, this row number 1, we have bought some shares of total this quantity. So whatever investment amounts we are doing, those has to be negative, and whatever we are getting in returns in the form of selling some shares like this, it has to be positive. And then for the today's date, you have to get your total portfolio amount here. So let's say it is this much, and then we will calculate our portfolio returns using XIRR formula. Here I will use this to our calculation. So firstly we need cash flows and then the debts. So I will convert this into okay. So we got portfolio returns of 20% here. So now interesting part is how to calculate the index returns. So for this, firstly, we will need the NIFTY values exactly of these dates. So we can make use of a function called Google Finance. So I will import NIFTY 50 values using Google Finance. So this is the Google Finance. I will use NIFTY 50 ticker and attribute will be price, and start date is this one, and I will check what it gives. So basically it is giving us a 3 by 2 matrix, and we want to have this value. So I will modify this formula a bit to get the desired cell. Okay, so we got the NIFTY for this date, and I will drag this formula as well to all our rows. Okay, so we have got all the NIFTY values. So after getting NIFTY 50 values, I will calculate units here, because we are now replicating all our cash flows into an NIFTY index fund. So with each cash flow, we are buying or selling certain NIFTY 50 units. So I will use this autofill except for the last one, because in the end we have to get the accumulation of all the units. So I'm summing all the units that we have acquired till now, and we got the total units here in this case. And then our index cash flow will be exactly same as our original cash flow. So I will just get all the numbers here. Again, I will delete the last cell, and I will calculate it from the accumulated NIFTY units. And final value is, this is what we are getting in return. So this has to be positive. So I am just making it positive in sign, and then we can calculate our index returns using same formula, but now with different cash flows. And the dates are also same. So I will convert it into percentage. So we, in this example, we got 20% portfolio returns annually and index returns of 11.4%. Now pause the video here and give it a try. Get your portfolio and index return. Trust me, the results might surprise you. Got your numbers? Great. Let's see what they mean. Let's say your portfolio returns are 7% and index returns are 12%. So your returns are lower than the index returns. Don't panic. It's just a feedback. Maybe your stocks or mutual fund selection strategy needs some attention. Or maybe it's time to simplify your method and simply consider index fund. And yes, don't forget to check if your returns are at least beating the inflation. Because if they are not, then your wealth is shrinking, not growing over time. If your portfolio returns are matching index returns, you are doing fine. But ask yourself, how much time, effort, and money are you putting in managing your portfolio? In the end, if it's same as index fund returns, then is it really worth it? Give it a thought. If you are beating the index returns, then congrats. You are doing great. Just make sure you are not taking unnecessary risk or ignoring hidden costs like taxes and brokerage. And ask yourself, is your strategy scalable and sustainable for the long term? Now let's discuss some of the questions you may have. What about dividends? Well, most dividend yields are around 2%, and here is the catch. Index returns we just calculate don't include dividends, so it's fair to ignore them when comparing. What if your Demat account already shows XIRR? If your Demat account shows XIRR, please double check if it includes all your past trades. Some platforms like XIRR don't consider the past trades. How frequently we need to track these returns? Personally, I check yearly once in the start of the financial year, but it's up to your choice. So here is the deal. Knowing your portfolio returns is not just about numbers. It's about understanding your financial progress. If you are behind the market, it's time to tweak your strategy. If you are matching, think about the effect-cost balance. And if you are ahead, well done. But keep the things sustainable. If this video helped you, give it a like, share it with your friends, and let me know your thoughts in the comments. Let's keep making the smarter investment decisions. Thank you.